Most people assume markets react to news. A war starts, metals rise, a war ends, metals fall. Clean, logical, predictable. Except that's not what just happened. Earlier today, silver pushed toward the $90 level again. Not gradually, not quietly. It moved fast enough that anyone watching the tape noticed it. But here's the strange part. The headline at the same time suggested the opposite should happen. Comments circulating this morning implied that the military operation involving Iran might conclude earlier than originally expected. For most traders, that kind of news normally reduces the urgency for so-called safe haven assets. In theory, silver should have cooled off. Instead, it went the other way. When a market refuses to fall on news that should push it lower, something else is usually happening underneath the surface. Not necessarily dramatic, not mysterious, just structural, positioning, liquidity, maybe even timing. The truth is, markets rarely move because of the story everyone is discussing. They move because of the pressures most people haven't noticed yet. And right now, silver appears to be sitting at the center of one of those moments. Before we jump to conclusions, though, it's worth slowing down and looking carefully at what actually happened. Because the facts themselves are already interesting enough. At the time this analysis was recorded, silver was trading near $89.63 per ounce. Earlier in the session, the metal opened around $83.65 before accelerating sharply during intraday trading. At one point, the price briefly touched $89.97, approaching the $90 level before pulling back slightly. Compared to the previous Friday's close of $82.91, that represents a move of nearly $6 within a single trading session. Gold moved higher as well, though the magnitude of the move was smaller. Gold traded near $5,238, roughly $63 above the previous close. In percentage terms, that places gold's gain around 2%, while silver's increase during the same period approached 7%. In the currency market, the US dollar index, DXY, was trading near 98.79, representing a decline of roughly 0.4% on the session. The day before, the index had briefly reached approximately 99.68. U.S. Treasury yields showed limited movement. The 10-year Treasury yield remained near 4.14%, indicating relatively stable bond market conditions during the same period. Equity market volatility also eased slightly. The CBOE Volatility Index, VIX, declined from approximately 29.49 in the prior session to around 25.5, though the level remained elevated relative to long-term averages. Within the metals complex, the relative performance between silver and gold stood out. Silver's price increase during the session exceeded gold's gain by a significant margin. In the physical metals market, exchange data also continued to evolve. On the COMEX, registered silver inventory was reported near 81.7 million ounces, representing the portion of exchange-approved metal immediately available for delivery against futures contracts. At the same time, the total number of outstanding silver futures contracts represented a quantity of silver significantly larger than the registered inventory available for delivery. Separately, inventory data from the Shanghai Futures Exchange, SHFE, showed a decline in exchange-reported silver stockpiles from approximately 559 metric tons in November to roughly 381 metric tons by February. These data points describe the current market conditions at the time of recording. No conclusions are required yet. The numbers themselves already outline the situation. Price movements rarely exist in isolation. They usually reflect a chain of reactions that begins well before the price itself moves. The first layer is positioning. In the weeks leading up to this move, silver had already experienced significant volatility. Prices rose sharply during the escalation of geopolitical tensions earlier in the year and later retraced part of that move. When an asset retraces after a major headline-driven rally, short-term traders often begin positioning for continued downside, assuming the catalyst is fading. That type of positioning creates an imbalance. If the market then moves unexpectedly in the opposite direction, traders who bet against the move may need to close those positions quickly. Closing a short position requires buying the asset back in the market. When many traders do this simultaneously, the resulting demand can amplify upward price movement. This mechanism is commonly described as short covering. The second layer involves relative performance inside the metals complex. In this session, silver rose substantially faster than gold. While both metals are often categorized as precious metals, their demand structures are not identical. Gold demand is largely driven by monetary and financial considerations. Central banks, reserve managers, and investors often treat gold as a store of value or hedge against currency risk. Silver, by contrast, sits between two demand categories. It is both a monetary metal and an industrial input. Industrial uses include electronics, solar panel manufacturing, and various electrical components. When silver begins to outperform gold by a noticeable margin, analysts often examine whether industrial demand expectations are contributing to price behavior alongside monetary demand. The third layer relates to physical supply and exchange inventories. Data from major futures exchanges, including the COMEX and the Shanghai Futures Exchange, provide insight into how much metal is currently held within exchange-approved warehouses. Only a portion of that inventory is registered for immediate delivery against futures contracts. When registered inventories decline while futures open interest remains elevated, the ratio between paper claims and deliverable supply increases. This does not imply a shortage by itself, but it does indicate that the margin for delivery stress becomes narrower if a larger number of market participants request physical settlement. Market participants monitor these ratios because they can influence trader behavior. If traders believe deliverable supply is tightening, they may become more cautious about maintaining large short positions. None of these factors alone explains a market move. But when positioning dynamics, relative metal performance, and exchange inventory trends all occur simultaneously, analysts begin examining the possibility that price movement reflects deeper structural pressures rather than a single headline or event. Understanding those layers helps explain why a single trading session can attract so much attention. Market conditions like the current setup are not entirely new, although each cycle unfolds under its own set of circumstances. Over the past 2 decades, there have been several periods when silver moved sharply ahead of gold within a short time frame. One notable example occurred during the 2010 to 2011 commodities rally. At that time, a combination of factors influenced the metals market. Global monetary policy remained highly accommodative following the financial crisis. Liquidity conditions were loose, and investor interest in hard assets increased. Silver, which historically tends to move more aggressively than gold during bullish phases, rose rapidly. Between mid-2010 and April 2011, the price of silver climbed from roughly $18 per ounce to nearly $50. The move attracted significant attention across both institutional and retail markets. However, the conditions surrounding that rally were complex. Industrial demand expectations were rising, investment flows into precious metals, exchange-traded funds were expanding, and speculative positioning in futures markets increased substantially. The outcome of that period is well known. Silver eventually retraced a large portion of the move, but the more relevant observation is what happened before the peak. In the months leading up to the rally's final stage, analysts frequently noted unusually strong momentum in silver relative to gold. That relative strength signaled that the metal was responding not only to monetary demand, but also to expectations related to industrial activity. Another period worth noting occurred during the 2020 pandemic market shock. In early 2020, financial markets experienced extreme volatility. During the initial phase, silver fell sharply as liquidity across markets tightened. But once central banks introduced aggressive monetary support, both gold and silver began to recover. Silver's recovery accelerated later in the year, eventually outperforming gold during certain periods. That move coincided with expanding fiscal stimulus and renewed investor interest in inflation-sensitive assets. These historical moments illustrate a pattern that occasionally appears in metals markets. Silver can transition from lagging gold to outperforming it when broader macro conditions shift. However, the current environment differs in several important ways. Global industrial demand patterns have evolved, particularly with the expansion of technologies that require conductive metals. At the same time, central banks around the world have increased their attention to reserve diversification, especially through gold accumulation. The similarities help provide context. The differences remind us that markets rarely repeat events in exactly the same way. Professional market analysis rarely revolves around a single prediction. Most experienced analysts instead frame the market through conditional outcomes. The goal is not to guess the future with certainty, but to understand how the landscape might change if certain variables shift. At the moment, the metals market appears to sit near one of those decision points. Bull case. Momentum extends. In the bullish scenario, the recent upward momentum in silver would need to stabilize above key price levels rather than fade after the initial surge. If silver were able to close above the $90 level and remain there for multiple sessions, that could indicate that the move is being supported by sustained buying rather than short-term volatility. In that case, traders would likely begin evaluating the next zone where previous selling pressure appeared. Historically, markets often revisit earlier areas of heavy trading once a breakout occurs. If momentum remained intact, analysts might look toward the $92 to $93 range, where prior price activity created a visible structural level during earlier volatility. In this scenario, confirmation from gold would also be relevant. If gold were able to hold above the $5,200 level, it would suggest that the broader precious metals complex is moving together rather than silver acting in isolation. None of this guarantees continuation, but such conditions would generally be consistent with sustained upward pressure. Base case, the consolidation. The base case assumes that the recent surge represents a rapid repricing event rather than the start of an immediate trend extension. Markets often pause after large single-session moves as participants reassess positioning and liquidity conditions stabilize. Under this scenario, silver might continue trading within a defined range while the market absorbs recent volatility. If price activity remained between approximately $83 on the lower end and $90 on the upper end, that range could represent a temporary equilibrium between buyers and sellers. During consolidation phases, several things typically occur. Short-term traders close positions. New participants enter the market with different time horizons. Liquidity providers widen or narrow spreads depending on volatility conditions. The result is often a period of sideways movement, while the market determines whether a stronger directional trend is forming. Such periods can last days or sometimes weeks depending on broader macro conditions. Bear case, momentum fades. The bearish scenario would require a clear shift in the factors currently supporting the market. If silver were to fall back below $87 and remain there, it would suggest that the recent rally failed to establish a stable breakout level. Under those circumstances, the market could revisit the prior support zone where buyers previously appeared. That level sits roughly in the $83 to $84 range, which served as a recent floor during earlier price action. Confirmation of this scenario could also emerge from the broader macro environment. For example, if the US dollar strengthened materially or if real interest rates moved higher, those developments historically tend to create headwinds for precious metals. In such a situation, the metals complex might transition from momentum-driven movement back into a defensive posture. Each of these scenarios depends on conditions that have not yet fully unfolded. Markets do not move in straight lines, and the path forward will depend on how these variables evolve over the coming sessions. When markets move quickly, the most useful approach is often to step back and watch a small number of indicators that tend to influence price behavior across asset classes. The first one is the US dollar index, DXY. Precious metals and the dollar frequently move in opposite directions, although not always in perfect correlation. Recently, the dollar approached the 99 to 100 range, which has acted as a resistance zone multiple times over the past year. If the dollar were to break above that level and hold it, that development could introduce pressure across commodities and metals more broadly. On the other hand, if the index continues drifting lower, the environment historically becomes more supportive for metals. The second area to watch is U.S. Treasury yields, particularly the 10-year yield. Real yields often influence investor decisions around non-yielding assets like gold and silver. If yields rise sharply due to stronger economic data or persistent inflation concerns, the opportunity cost of holding metals increases. If yields stabilize or decline, metals tend to face fewer macro headwinds. Another data point worth following is inflation reporting, especially the Consumer Price Index, CPI, and Personal Consumption Expenditures, PCE, inflation measures. These reports help shape expectations around Federal Reserve policy. Changes in policy expectations can influence currency markets, interest rates, and in turn, precious metals. Liquidity conditions also matter. Trading volume, futures open interest, and exchange warehouse inventory levels can provide insight into whether a move is being driven by broad participation or by a narrower group of traders. When open interest expands alongside rising prices, it may indicate new positions entering the market rather than existing ones simply closing. Finally, I pay attention to physical market signals, including exchange inventories and spot premiums in major trading hubs. These indicators sometimes reflect demand conditions that are not immediately visible in futures prices. None of these indicators provides a complete answer on its own, but together they form a framework that helps explain why markets behave the way they do. Markets rarely move in perfectly straight lines. Periods of rapid movement, like the one we've just seen in silver, tend to attract attention because they happen quickly. But experienced investors usually focus less on the speed of a single move and more on the conditions surrounding it. Right now, several variables are evolving at the same time: currency movement, interest rate expectations, and physical demand indicators. Any one of those can influence how the metals market behaves in the coming weeks. That is why patience often matters more than immediate reactions. Watching how the market responds to key levels, monitoring macro indicators, and maintaining disciplined risk management tends to provide a clearer picture over time. None of this should be interpreted as investment advice. It is simply how I'm reading the market structure at the moment. As always, the goal is not to predict every move, but to understand the environment well enough to make thoughtful decisions when conditions become clearer.